Every year, a group called Mercer and the CFA Institute rank the world's pension systems. 52 countries, more than 50 separate indicators, adequacy, sustainability, integrity, the whole apparatus of what actually makes a retirement system work, rather than just look good on paper. In 2025, Denmark placed third in the world. The United States placed 30th. Same year, same methodology, the exact same questions asked of both countries, with no thumb on the scale for either one. And the gap between third and 30th isn't a rounding error you can wave away with a footnote. It's the difference between a system built to hold up under real pressure and one that mostly gets by, year to year, hoping nothing shifts too much. So today we're not talking about hygge, or bike lanes, or free university, the usual highlight reel every video about Denmark eventually reaches for. We're talking about one specific habit buried quietly inside Danish paychecks that most Danes barely think about, because it was never designed to be thought about in the first place. That's actually the whole point of how it works. The best financial systems tend to disappear into the background of ordinary life, rather than demanding constant attention from the people relying on them. And by the end of this video, you'll understand exactly why a country, with genuinely brutal tax rates, somehow produces retirees who aren't lying awake at 2 a.m., doing math on the ceiling, running numbers that never quite add up the way they need to. Before we go on, let us know in the comments where you're watching from. We love seeing how far this story travels. And if you're loving it so far, join the family by hitting subscribe, because tomorrow, we've got something special lined up just for you. Let's start with the number that made me want to make this video in the first place. At the end of 2024, Danish pension assets reached about 206% of the country's entire GDP, not 20%, 206. For comparison, the OECD average sits closer to 92%. The United States, despite having the largest pension pool in the world in raw dollar terms, over $42 trillion, sits at about 153% of its own GDP. Denmark, a country of under 6 million people, has more retirement money saved relative to its economy than almost anywhere else on Earth. Albania, at the other end of that same OECD chart, sits under 1%. How does a country do that? Not through some national investment genius, and not through Danes being unusually disciplined savers who wake up early to check their portfolios. It comes down to something much less exciting. The money leaves before anyone has a chance to decide whether they feel like saving it this month. Here's how it actually works. Most Danish employees are covered by what's called a quasi-mandatory occupational pension. Quasi-mandatory is a strange phrase, so let's unstick it. It's not written into national law the way income tax is. It's written into collective bargaining agreements, the ones that cover the overwhelming majority of the Danish workforce. And once you're covered by one of those agreements, contributing to your pension is exactly as optional as showing up to work. Typically, that means somewhere between 12 and 18% of your salary, with your employer covering about 2/3 of it and you covering the rest, going straight into a pension fund before it ever touches your bank account. Layered under that sits something even older. ATP, short for Arbeidsmarkedets Tillægspension, which has been running since 1964. It's smaller, a flat amount rather than a percentage, a few hundred kroner a month depending on your hours. Your employer pays 2/3, you pay 1/3, and it happens automatically the moment you're employed 9 hours a week or more. You don't sign up for it, you don't get asked. It's simply attached to having a job in Denmark, the way a social security number is attached to having a job in the United States, except this one comes with money actually accumulating behind it, rather than a promise to be paid out of whatever future tax revenue happens to exist. Put those two together, and a Danish worker can easily be setting aside 15% or more of their income for retirement, without ever making an active decision to do so. No open enrollment period. No email reminding you to bump up your contribution rate. No moment where you have to compare this month's grocery bill against your future self and pick one. This matters more than it sounds like it should, and there's actual research behind why. Behavioral economists have spent decades studying what happens when retirement saving requires an active choice, versus when it's simply the default. The findings are remarkably consistent across countries. Participation rates in voluntary retirement plans, even generous ones with employer matching, tend to hover well below full enrollment. The moment a plan becomes automatic, with saving as the default and opting out as the effort required, participation jumps dramatically, often into the 85 to 95% range almost overnight. The plan doesn't get more generous. The paperwork doesn't get simpler. The only thing that changes is which direction requires a decision. Denmark essentially built its entire pension architecture around that finding, before most of the research existed to justify it. Saving isn't the thing you have to remember to do. Not saving is the thing you'd have to actively arrange, and almost nobody bothers. Compare that to how retirement saving typically works in the United States. A 401k is there if your employer offers one. You have to enroll. You have to pick a contribution percentage, guess at what you can afford, choose your own investments from a list of fund options that assumes a level of financial literacy most people were never taught in school. Every one of those steps is a place where someone can simply not get around to it. Not because they don't care about retirement, but because there's rent due this month and the pension enrollment email can wait until next week. Next week, predictably, becomes next year. Preparing and narrating this story took us a lot of time, so if you are enjoying it, subscribe to our channel, it means a lot to us. Now back to the story. The Mercer Index actually breaks down why the US lands at 30th instead of somewhere near the top, given that it's one of the richest countries measured. Adequacy score of 64, sustainability at 60, integrity at 58. None of those numbers are disasters on their own. Adequacy is basically asking, will people actually have enough to live on? Denmark's system was engineered around the idea that saving shouldn't depend on remembering to do it, that a decent floor should exist under everyone before individual choice ever enters the picture. That structural difference shows up directly in the adequacy score. And the adequacy score is the one that eventually determines whether someone's retirement feels like relief or like rationing. None of this means Danes pay nothing in, or that this is somehow free money conjured out of good policy. 12 to 18% of a salary is a real number. It shows up as lower take-home pay every single month, for an entire working life, no different in principle from the automatic tax withholding most workers everywhere already accept without a second thought. The difference is what that withholding is actually for. American payroll tax funds Social Security, a program under real long-term funding pressure of its own. Danish occupational pension contributions go into an account with your name on it, invested, growing, waiting specifically for you rather than for whoever happens to be retiring the year the fund gets stressed. There's a psychological piece here too, and it's worth naming directly because it's easy to miss if you're only looking at the contribution percentages. When saving is automatic, it stops being a source of guilt. Nobody in Denmark spends their 30s quietly dreading the moment they'll finally have to sit down and figure out their retirement plan, the way that dread shows up constantly in personal finance conversations elsewhere. The plan already started the day they got their first real job. There's no starting late, because there was never a starting line to miss in the first place. It's worth being honest about what doesn't transplant easily here, because pretending otherwise would be dishonest. This system runs on the same institutional trust that shows up in nearly everything else about Denmark: a workforce heavily covered by collective bargaining, employers who don't fight the arrangement because it's simply how hiring works there, and a government willing to let sector agreements do work that other countries leave to individual choice or federal law. A country without strong collective bargaining coverage can't simply copy the percentage and expect the same result, because the mechanism doing the actual work isn't the number, it's the automation sitting underneath the number. But the underlying principle survives the trip even when the specific machinery doesn't. If you've ever set up an automatic transfer into a savings account on the day your paycheck lands, specifically so the money is gone before you can talk yourself out of it, you've already been doing a smaller, individual version of exactly what Denmark does at a national scale. The Danish system just proves what happens when an entire country, builds its retirement architecture around that same one insight. Not more willpower, less opportunity to need any. Third place out of 52 countries. Not because Danes are smarter about money, and not because the market treated them better than it treated everyone else. Because somewhere back in 1964, someone decided that retirement security shouldn't depend on a person having a good week, a clear head, and 20 free minutes to fill out a form. Follow along if you want more of these breakdowns, and let me know in the comments. Does your employer offer any kind of automatic enrollment, or is saving for retirement still something you have to remember to start yourself? That's our story. If you enjoyed it, hit like, subscribe, and turn on the bell. And tomorrow, more stories are waiting for you. Thanks for watching.